Hi everyone, welcome back to this video series on market timing. This is the second one where I will try to quantify or illustrate rather how much upside there is potentially for the ability to market time. And obviously this is not something that that is realistic. The assumption I'm making here is that I'm assuming this is a perfect foresight investor who is capable to exactly know what is going to happen over the next month, over the next quarter, and accordingly positions himself to gain from these market movements. But it's interesting just to see how much actually is out there if such a perfect foresight investor could realize profits in comparison to a very important benchmark, which is just buy and hold. So let's take a look at that. This is an example that I have from the literature. At the end of this video series, in the link that you found this video, you will also see like the literature that I'm using to put together these videos. And this example here is from Grauer, a paper that he wrote where he goes through this very specific case where he first makes the assumption of like quarterly rebalancing. And he looks at a time period from 1934 to 1999, so 65 years, 66 years of data. And so let's say we are in December 31st, 1933. And so that investor knows exactly in March 31st, 1934, a quarter later, whether 3-month treasury bills outperformed the US stock markets or vice versa. And if the former is the case, so if treasury bills were performing better than the US stock market, that investor puts all his money into treasury bills. If this US stock market was performing better, in contrast, that investor will put all his money into stock markets. And then in March 1934, at the end of March, he will then have the perfect foresight to see what will happen by 30th of June 34. And if the stock market, for example, performed better, he would accordingly invest in the stock markets and vice versa. So what are the annual returns? You have here like the perfect foresight investor, just the way I outlined it, and as a benchmark, it's just buy and hold stocks. So in on the first day of 1934, you put all your money into US stocks, and in December 31st, 99, you take it out. How much annual return would you have realized in that case? So I'm going to write this down into this into the summary table. The annualized return was something like 14% for just buy and hold. Sorry about that. Just for buy and hold. And that would have given you, in the end, if you had invested $1, it would have given you a terminal wealth of about $2,100. So to be more precise, $2,097. Okay, so over 2 generations, over 65, 66 years, you would have made something like 2000x. That's the benchmark. Now, for a perfect foresight investor, that annual return would have been instead 24%. So during periods of like drawdowns, that person would have invested the money in 3-month treasury bills and would have gotten a safe return back. The person would have avoided these massive drawdowns that have occurred in this history of 60+ years in the US stock market. And the terminal wealth would have been in the neighborhood of $1.3 million. Okay. So a couple of things first. When you see here 14% annual return for the US stock market in these 65 years, that's actually a very, very high number. It's typically not that high when you look at longer time series. And the reason why we have 14% here is just because when you look at the window, the time series here that the person that Grauer looked at from 34 to 99, we don't have the massive drawdowns from 29 to 33 in this sample, and we don't have the massive drawdowns in 2007 to 2009 in this sample. So that is actually a very interesting lesson also to learn here, which is that if you can avoid just a few like very bad years, if you knew, quote unquote, that you are in a prolonged bear market, you can actually massively boost your returns from something like an average of 7% to 14% already. I'm not saying this is possible, but this is just the idea of like timing losses sometimes can be another very tremendously helpful strategy to pursue. And the other thing, the other takeaway obviously is that this terminal wealth, I mean, 2100x is extremely strong. And I mean, people will be like over 2 generations so much better off just to buy and hold instead of just trying to time markets. And many people can't do it. They can't do it because they don't have the skills to develop models, whether quantitative or discretionary ones, to time markets, or they face psychological challenges that I mean, sometimes you can actually have very, very sharp drawdowns, but you're still compensated for sticking to a model, and people just give up. So just the buy and hold is actually already a very strong performance. But when you assume that there is something to be done about market timing, the upside is even like more tremendous. It's like 630 times more than just the simple buy and hold. So that's it for today. That gives you like an idea of the potential upside of market timing. And in the next video, I will go a little bit deeper into buy and hold and artificial stupidity. See you next time.